Good morning, students. Welcome back. So today we are going to start with this new discussion. With this new topic on the risk assessment and the internal control. This again, I would say, is a continuation. Even though it's a new chapter, but definitely it's a continuation in terms of the discussion we have had in the previous session, wherein we picked up the audit planning. Remember? Now, when it comes to the audit planning, okay, so now what do you have in the audit planning? So there are a lot of aspects which are there in the audit planning, wherein we come up with the understanding. We try to get into the processes. We try to understand them. Then we also get into this audit strategy, audit program, right? But when you talk about this audit strategy, audit program, some of these things, what becomes the basis for this? In fact, the discussion that we had in the previous session, we talked about the audit which is based on risk. Yes or no? Yeah. So the risk is the orientation. You can say that's the focus around which the auditor will always plan to audit. The auditor will be thinking about the audit procedures, right? So now, in that respect, when you look at that audit approach, therein this risk is required to be assessed. Yes or no? Because if the auditor has to think of as to what will become important for him and what will become maybe not so important for him. Okay, so these are the two buckets he would want to consider. So in that case, the important consideration for the auditor will be what? This risk. Yeah, so that means somewhere the auditor will have to assess the risk. Only and only when it is done, auditor will get to know as to what is significant and what is not so significant. Right? Now, in that respect, when we talk about something that is significant, something that is not so significant, this risk assessment plays a key role. And for this risk assessment to be done, we need to have a clarity as an auditor as to what the risk is, how the risk is going to impact the organization, means what are the risks from the management's perspective. Yeah. And of course, what are the risks which are important for the auditor to consider? Correct. Yeah. So we are looking at both the perspectives here. All right. So now, anyone would like to have a discussion? I understand, Saminathan, you are around. So any thoughts, if you have, as around the risk, as around the risk assessment, and of course, what is it that internal audit has to do on this? So if you can just give me a broad overview in terms of what you understand. Any thoughts on this? Before we get on to this detailed discussion, any thoughts? Yes, Saminathan, any thoughts if you have on this? Yes, sure. Please go ahead. Please pick up.
Good morning, sir.
Good morning.
The internal control, internal
Right.
audit, he will design the procedure,
Right.
policies and procedures to test the controls
Hmm.
within the organization
Hmm.
and whether as per the policy and procedure, all the process are processed or not.
Hmm.
He will have that. Based on that, is there any shortage? He will find out and he will report to the management, and also he will continuously monitor to rectify the same.
Okay. Now, what is it that the risk assessment has to do on this?
Risk assessment, um, based on the material misstatement, by way of fixing that materiality,
Hmm.
they will check the material assessment whether there is
Hmm.
any due to fraud or error in the financial statement on the
Okay.
assessment level as well as the financial statement level.
Right. All right. Good. Now, what we will try to do is we will try to get into a detailed assessment of some of these requirements. And of course, we'll also try to understand as to what the internal control has to do in this case. Okay. Now, as a first step, we need to understand what this audit risk is. Yes or no? So, as far as the auditor is concerned, let's try to understand as to what could be the risk for the auditor. So, there is a very simple risk we can just say, we can understand, or we can just think of. And what is that? See, the auditor is there to audit. Okay. In case he is not able to audit the way the audit is required to be done for any reason, that's a risk for him. Yes or no? That's a risk for the auditor. Correct. Now, if we have to become slightly more technical in terms of our discussion, so what can we say? There is a risk that the auditor may not be able to express an appropriate opinion on the financial statements. There's a risk that the auditor may not be able to find out material misstatements, and therefore he may be expressing inappropriate audit opinion. So that's the risk. Yes or no? That's the risk which you can think of and which could be there in the audit. Yeah, in a very simple manner. Now, all this strategy, audit program, all the discussions around it. Okay, so when you think of this risk assessment and the audit approach, audit planning, why is this all required? What is the objective? Yeah. So if we look at the objective as to why all of this is really required, is to cover or to sort of mitigate this risk. Because as an auditor, what would he want? He would want that whatever he has done is the best to his capabilities. And this is also in line with what is required by the auditing standards or maybe any of the regulatory requirements. Correct. Now, for doing this, auditor needs to have a clarity on some of the risks which exist in relation to the audit of the financial statement. So we are not talking about the management risks right now. What do you mean by management risk? Let's also try to understand that. Now, during the course of the audit, what will the auditor do? Auditor will look at various transactions, look at various agreements. There are various events which would have taken place. Yeah, all of these things he'll be looking at. Correct. Now, in respect of all the transactions which the company have had during the year, what is the risk from the company's perspective? That the transaction may not have occurred maybe the way it's required as per the policies, procedures of the company. Correct. So that's a risk. That's a risk from the audit perspective. And that's a risk in relation to the transaction which the management would have carried out. Now, for doing this, what would the management do? I'm not talking about the auditor right now. Management will identify every risk which is associated with that particular transaction, that arrangement, and will also try to have a control in place. For example, when a payment is processed to a vendor, so there's a risk that the payment is made, let's suppose, to vendor B instead of vendor A. Yes or no? Yeah, so there could be a risk that the payment is processed to a wrong vendor. Now, this risk is important. Why? Because if the risk is not addressed, then the transaction will go wrong. And this is something which the auditor also needs to consider. Correct. But first of all, management needs to consider that before the auditor. And for the management to consider that, for the management to get into this, what would they need? They need to have controls in place. So what can the management do? Management will set up a process, will set up a control that every time a payment is made to a vendor, it would require checking of the invoice against which the payment is being made. Number one, any payment before processing will also require approval. Okay, so thereby the management is just trying to mitigate the risks which are associated with that particular transaction. Okay, now in this case, the risks that we are talking about, these are not the audit risk. Okay, you may be thinking now, what is audit risk? We will come to that as well. We are thinking about those risks which exist in the process, in the transactions of the organization, which the management needs to look at. They need to identify, they need to assess, against which they also need to put controls. Understood? Yeah. So that is what you call as identification of risks, as well as setting up of control system by the management. All right. So these are the two things you get to see. But this is from the management's perspective. This is not really from the auditor's perspective. Now, let's come back to the risks which are there in the audit. Okay, and let's now try to understand what are those risks. Now, see, there are few components of audit risks. Let's try to understand. First, inherent risk. What do you mean by inherent risk? Say, for example, see, there is an industry. Okay, so when you are auditing a company, so there is an industry. So in that particular industry, there are certain processes, there are certain transactions, which will always have some risk involved. Okay, which will always have some risk involved. Why? Because that's the feature, or you can say the way that industry works. There's always a risk which is associated with that particular company or the client. Okay, so that is not specific to the company. Okay, that is specific to the industry. Means within the industry that particular risk exists. Now, because this is the risk which is related to the business, to the industry, so that's why it's inherent to the company. Okay, now Because these are inherent in the business of the entity which is being audited. Auditor will have to look at, auditor will have to consider those risks. See, each and every risk will have to be considered, but some of these risks will also have to be considered. For example, technological advancements might make a particular product obsolete, thereby causing inventory to be more susceptible to overstatement. Okay. Now, when we talk about technological developments, okay, so if you look at some of the industries, therein these technical advancements are quite common. For example, if you talk about auto sector, if you talk about pharma, okay, so therein you keep coming up with some sort of advancements, okay, some sort of new things. Yeah, so they are prone to these types of things. Swaminathan just mentioned, for example, mobile phone. Okay, yes, of course. Yeah, so every now and then, what do you see? The model is changing, right? Now, in this case, there is one risk that we talked about, and what is that? Inherent risk. Now, what is the second risk? Control risk means the risk related to control system of the organization. We are not talking about control system of the auditor. We are talking about control system of the organization. Now, what is this risk? It's a risk that the entity's internal control system will not prevent or detect and therefore not correct on a timely basis any misstatement that could be material. Now, when we are looking at the management process, or you can say if you look at the functions of the organization, so as an auditor, what do you want? They should have strong controls. They should have a good process. We should take care of any misstatement. Okay, so ideally, there must be a mechanism which is in the nature of preventive. Okay, so that some of these things do not arise. Or even if they arise, there should be a mechanism to detect and correct. Yeah, so first of all, what do you want? The problem should not occur. But if let's suppose that has occurred, at least you should be able to identify and rectify that. Correct. So this is what you should try to do as an organization in terms of your processes, in terms of your systems. But what if such system is not working in the organization? See, definitely the management will want, but let's suppose if that system is not working, if that control is not working, if that control fails, so can we just say that because there's a system in place, there is a process in place, so that's why we will uh, just ignore any of the aspects around it and will just you know uh, be ignorant of that fact? So will that be appropriate? Answer is no. Okay, because if we do that, then somewhere there is a problem, not only in the system of the organization but in our system as well. Okay, so therefore this is the second risk which gets attached, which the organization needs to look at. Okay. Okay, this is for them to look at. Now, entity should do what? Entity should identify and assess its business and other risks. Okay. Yeah, so they should identify, assess business and other risks. Anything as around fraud, and should design and implement that system of internal control. Okay. Wherein you'll have different types of controls. So we are actually talking about a control system to be in place. Despite that, some control risk will always exist because of the inherent limitations of any internal control system. So what should the auditor do? Auditor is required to understand the entity's internal control and perform procedures to address the risk of material misstatement. Okay, so we can say this is the second important consideration as far as the audit risks are concerned. Understood? So we are now talking about the audit risk. Okay, now moving on to the third category, detection risk. So see, the auditor will be doing the work in a diligent manner. Okay, but can we say that the auditor will be checking each and every transaction? Means will he be looking at 100% of the transactions? Answer is no. Yes or no? See, the auditor is required to issue an opinion, right? For doing this, what will he do? He will be looking at reasonable assurance. Correct. What is the meaning of reasonable assurance? Means he is looking at the samples. He's not looking at each and everything to begin with. So that's the first thing. Okay, so the sampling approach is being considered by the auditor. So that's one. Number two, when it comes to the focus of the auditor, so he's only looking at the material items. Or you can say his focus is what? That the material misstatement should not miss out. But there's a risk. What is the risk? That the auditor may not be able to detect a misstatement that exists. So why do you think this sort of risk may arise? Let's suppose audit procedures are inappropriate. Okay. Or maybe the audit procedures were also appropriate. But in terms of drawing the conclusions, auditor has made some mistake. Okay. So he erred in terms of the conclusions. So that could also be a concern for the auditor. So no, that could also be a concern for the auditor. So there are certain considerations which the auditor needs to look at. Now, in respect of the risk that the procedure has been performed, which may not be appropriate, or the appropriate procedure was performed, but the outcome is not the desired one. So there are chances at times that some of the misstatements, which may be material, go undetected by the auditor. To say that the auditor will be able to detect everything in terms of the material misstatement, so there's a risk which is attached. So we are not saying that auditor is not diligent. So despite being diligent, despite following everything which is required to be done, he may miss out on some of the things. So this is what you call as detection risk. Okay. Yeah. So now, in this case, there are three types of risks that we talked about. What is that? Inherent risk, control risk, and detection risk. Okay, so mathematically also at times it is expressed as a product What is that? It's a sort of three things that you look at in terms of assessment of the audit risk. Okay. Now when we talk about these three risks, so there are two risks which are in relation to risk of material misstatement. What is that? The financial statements which the auditor is going to get for the purposes of audit, they already had a misstatement. Okay, so there's already a misstatement in the financial statement. Why? Because ideally the management should have taken care of it, but because their systems, their processes were not strong enough, so that's why financial statements contained a material misstatement. Okay, means where are those risks arising from the management? So when you talk about inherent risk, it is arising from the management only. If you talk about control risk, so why are we saying it's a control risk? Because we are saying somewhere the control system is failing. If the control system fails, there are chances material misstatement may flow to the financial statements also. Okay, so the financial statements which the auditor is going to get may have the material statement, which could be because of inherent risk or control risk, right? This is a third category. So the third category, when we talk about detection risk, in this third category, one should understand that management has no role to play in this. Yes or no? Management has got nothing to do with the detection risk. Why? Because as far as the audit is concerned, audit procedures are concerned, audit approach, audit strategy, audit program, okay, all of these things. Has the management got anything to do with this? No, this is something which the auditor is required to do. So if the auditor fails in any of these things, can we say it's because of the management? Not really. Yeah. So that's why the third risk that we talked about, detection risk, is something which belongs to the auditor. Okay, so what is this risk? That the auditor will not be able to detect the material mistake. Yes, that's how you can say, you can just categorize these risks. Okay, so what is the first category? Risk of material misstatement in the financial statements, which comprises of inherent risk and control risk. And what is the second category? Detection risk, right? So if you look at the first category, it is something which comes from the management, which comes from the entity. If you look at the second category, it comes from the audit side. Yeah, again, we are not saying that this has been intentionally done by the management or the auditor. We are saying it's a risk which is present. And that's why the auditor needs to plan his audit procedures so that all of these risks are taken care of. Yes or no? Yeah. All right. So now we talked about some of these risks, what is required to be done in terms of consideration of these risks. Now, let's talk about risk assessment as a process. Okay. Now, what do you mean by risk assessment? See, because we understand there are a lot of risks which are present. So that's why what is the first step? Identification of the risks. Yes or no? So what should be the first thing you should do? Identify the risks. Because only and only when you identify them, you will be able to think of the course correction. Without that, you will not be able to do. Yes or no? Yeah, so when do you do that? Because you think about it. Okay. So first of all, the auditor should have a process to assess the significance of the risks which are assessed by the management. Okay. Now, in relation to that entire process, this consideration is required to be given. But when you look at it as to how this is required to be considered by the auditor, what are the things which the auditor will consider? Okay, so of course, the auditor will go by the assertions. Yeah, so he'll be looking at all of these things by the assertions. So that approach he needs to consider. That's the basis for the auditor to get onto these things. Okay, so now what we can do is we can just maybe first of all look at some of these requirements in relation to the risk assessment as to how the risk should be assessed, how the risk would have been identified, okay, and eventually what is it that you will do as an auditor. So let me just pick up one working file. So let's pick up any process to begin with. Okay. So what we can do is maybe we can just pick up process, and with the help of that process, we can just try to identify all of these things. So now, at the first place, we are looking at process of the organization. As an auditor, what do? As an auditor, you will obtain an understanding of this process. Right? So this should be your first step. You need to obtain an understanding of the process. Okay. Now, what is the process? Say we are talking about the process related to procurement. Okay, so let's pick up the procurement. Very good. So Swaminathan just mentioned that we need to understand the environment, all of these aspects. Absolutely right. So now in relation to the procurement process, of the organization. Okay. What do? We obtain an understanding, right? Means you will thoroughly understand what are the steps, what is the flow of transactions. Now, why is this understanding important? So this is what we have already talked about. Till the time you don't obtain the understanding, you will not be able to think of the most important aspect. What is that? What could go wrong? Now, this what could go wrong means what? Means the risks. Okay. Let us take a very simple example on this. Say the material has been purchased. Now, in the procurement process, you will be looking at the material. Say the material has been purchased by the organization. Okay. But physically that material is not received. Is that a risk? Yes, of course, there's a risk that every time the purchases are made, invoice is received against which the payment is also made, but physically the material is not received, or maybe the material that we receive is short. Okay, so let's suppose the entity ordered, say, 200 items, but they have physically received only 150. 50 are not received. So what do you call it as? You call it as a risk. Yeah, so it's a risk which exists. Now, in relation to this risk, what do we need to do? We need to, first of all, identify this. Because anything as around this risk, if you have to do, that is only possible when you will be able to identify this. Yes or no? So that's why identification of these risks is important. But the good thing is that this identification is not something which the auditor would be required to do. Management would have already done that, or management should have already done that. Yes or no? Yeah. So the management should have already looked at it. But till the time identification is not done, if let's suppose there are, in a similar manner, the way we discuss this risk, let's suppose there are 100 risks which exist in this particular process. If you are not able to identify all those 100, so what will happen? What will happen? The outcome of that process may be leading to some material misstatements which are flowing into the financial statements. Yeah. So that's why if you have to prevent that, so what do you need? You need to identify the risks. Now, in relation to all of these things that you will do, you also need to look at the assertions as an auditor. Yes or no? So each type of risk or every risk that you come across, so which assertion is getting impacted due to that? So that you need to find out, that you need to look at. Right? Correct. Because once you have the mapping of all these types of risks which have been identified as against the assertions which are there, that is when you will be able to understand the impact of that on the various items of the financial statements, or you can say on the financial statement as a whole. Right or not? So this is your second step, and this is important because only and only when you have that in place, what will you do? You will be able to at least know the problem. See, what is our objective? One should know the problem. If you know the problem, that is when you will be able to address it. Otherwise, if you don't know the problem, how do you address that? Correct. Now, this is, I would say, broadly about the types of risks and in terms of identification. And of course, you will be looking at those, you will be assessing that with the mapping against the assertions. Now, further to this, if you look at the management process, so let's come back to the management process only. Now, see, the management would have also set up some controls. Now, what do you mean by control? Like in relation to the risk that we talked about, that the material is purchased, but physically it's not received. So what will be the control? So the control could be that every time a purchase is done, so the stores department or maybe any of the relevant department, they need to physically inspect the material which has been purchased. So that could be a control. Yeah, so there's a team, there's a department which is responsible for that. Only then the invoice would be sent to the processing for payment. Before that, it will not be sent for processing. Okay, so now in this case, what do you call it as? You call it as a control. Okay, so there will be a system of controls. Now, who will have that system of control? It is again that of the management. Here again, the company, the management will be doing this. Correct. But as around this control process, as around the system which would be in place, what is it that the auditor will need to do? Auditor will need to understand whether this control system has been set up or not. Yes or no? So whether it is set up by the organization or not, means at least this system should be there. Number two, let's suppose they have set up, means they have put down everything in terms of their policies, procedures, that this is what is required to be done. But that is not implemented. Okay, so it should also be implemented. So the implementation has to be there. And further, that must be operating. Yes or no? Because if let's suppose that's been implemented, but that is not operating. That is not operating in an effective manner year on year. Okay, so operating effectiveness. Right? So these are the things which the auditor needs to consider. Right? Now, how does it help the auditor? See, actually, this is what we also call as planning. Actually, what is the planning? This is nothing but a part of planning only. Yeah. So in a way, you may be discussing some of the different things today, but as a package, if you look at this, if as a process, if you look at this audit, so this is nothing but a part of planning only, because while planning, auditor will be considering all of these things. Why? Because till the time the auditor will not have clarity as around the risks, as around the controls, he may not be able to select, he may not be able to design his audit procedures. Yes or no? Yeah. So now, how does it help the auditor? See, if all of these things are taken care of, risk identification is done, risk assessment is done, control system has been put in place, which is also working in an effective manner. In such a case, what do you do? In such a case, you get the comfort as an auditor. Yes or no? Yeah. You get the comfort that the process which has been put in place is good enough to take care of any risk, to prevent that, or even if that is not prevented, to detect that. So as an auditor, your comfort level will increase, and that's how you will be looking at your audit procedures. That's how you will be looking at extent of your audit testing. Correct? Yeah. All right, great. So Saminathan, anything as around this which you believe is as relevant for the auditor to be considered? So can you just think of an example to discuss this situation? Over to you. Any thoughts on this?
So control, the internal control is very important
Okay.
aspect to for determining the risk of material misstatement. So
Right.
management has to play a vital role to incorporate and implement the internal control system in place. So that
Okay.
is very, very important to mitigate the risk from the
Okay.
management side,
Hmm.
which will be useful and easy to uh, do the auditor side as well to proceed further.
Okay.
So this is what I feel as of now, sir. The control.
No, so any example which you can think of, okay, in terms of the discussions we have had.
Example, if it is a payroll process, they should set up that policies and procedure
Hmm.
that has to be communicated to the employee what they have to do, and from the HR side what has to be done, and how the payment payroll process is done. That
Hmm.
overall they have to set up a design and policy and procedure. It has to be communicated well in advance. So accordingly, whether it is working or not, the effectiveness it has to be tested by the management. So it
Okay.
will be the outcome also to be seen. It has to be independent way actually. There
Okay.
should not be any bias.
Right.
By way
Good.
of that, we can achieve the overall objectives of the
Hmm.
audit, which is
Hmm.
the free from fraud or error.
All right. Good. So I think it's good thought you have shared. Now what we can do is we can just maybe get into the further details of this control system. All right. So now broadly we have tried to cover this entire perspective, what this risk assessment is all about, and what this control system is all about, and how does it really help the audit. Because what is our objective? Our objective is that as an auditor, those three risks, remember those three risks, are
Yes,
taken
sir.
care of. Okay, that is our objective. Now, all of these things are helping me as an auditor. Yeah, so now let's get into the finer details of this control system, which will be there. Now, objectives and all, I think we have already understood. So, what are the objectives which you will have for the control system? Transactions are executed as per the process, they are authorized, they are promptly recorded. Any of the items are, as far as assets are concerned, safeguarded. They are verified at reasonable intervals. And of course, for any discrepancies, there's an appropriate action. Okay, now, what should be the structure of the internal control? First of all, there should be a proper system so that people are aware of what is required to be done, who is required to be done. Yes or no? So if let's suppose there's a job, so there should be a clarity who is required to do what. And broadly, this is what you call as segregation of duties. Because if that is not done, what will happen? Things will not be moving in an organized manner. Correct? Yeah. So you'll be doing things, but the things that you do, you'll not be able to do that in an organized manner, which is extremely important. Okay. Now, in relation to segregation of duties, so there are various functions you'll look at: execution of transaction, authorization of transaction, physical custody. So, any of the activities that you talk about, for everything, you need to have a segregation of duty. So, there has to be a clarity as around any of the things. Okay. Because if that clarity is there, how will it help the organization? So, if let's suppose there's a person who has been assigned, and every time any time any salary is paid, so who will process the payment? So that person will process the payment. Before that salary payment, there is another person, say person B. So there is person A who will process the salary payment. There is person B who will check the details of salary to be paid. Okay. So now, if let's suppose later on there is any problem in terms of salary payment, so at least accountability will be there. Yes or no? Because if let's suppose segregation of duty is not there, so will there be an accountability? No, accountability will be very, very difficult to be established. Correct. Yeah. So these things become important. So accountability is what you are required to look at. Correct. Now, moving further, there are some components of internal control. So let's talk about those components. See, for the purposes of our discussion, there are five components, the way we are going to look at it: control environment, risk assessment process, activities related to the control, information system and communication, and monitoring of controls. Okay. Now, what is this control environment? See, actually, when we are talking about control environment, we are largely talking about the system which is in place. See, for an organization to function, there must be a set of policies, procedures. See, in terms of discussion on the control, if you are talking about a particular transaction, if you are talking about a particular risk and the mapping of that risk with the control. So over here, we are not looking at the transactional aspect. We are talking about the system as a whole. Means the environment which is set up. Okay. Now, communication and enforcement of integrity and ethical values in the organization. So actually, what should happen? The ethical values, integrity, okay, any of these things that we talk about are very important. But as an organization, what is the first thing? You want to pass on a complete understanding as to what do you want to do? How do you want to do? So if there's a particular set of transaction, if let's suppose there's a way of doing the work which you want to follow as an organization. See, every individual will have his own style of doing the work. But if let's suppose there's a particular way you want to do the things, okay, so this is the only way you'll do the thing. So what do? You'll have to set up a system. Okay, so that messaging has to go out, that communication has to be in place, right? Commitment to competence. So we are talking about the knowledge and the skills. So as an organization, you need to think through what is the knowledge level you want in terms of the things which are required to be done around the skill set which has to be in place in again in respect of various activities which are required to be looked at. Yeah. Over here, it is again important for the top management, for the senior management to stay engaged, okay, to be involved. So that's why participation by those charged with governance. Who, what is that? So basically, we are talking about the board here, yeah, or the audit committee here. Yeah, so they need to pass on this again, complete clarity as to what is required to be done. Yeah, so the management's philosophy and the operating style. The way the organization is structured will again have an important role to play in this. Yeah. So everybody who is given some responsibility, so there should be a clarity on this, number one. And appropriate level of authority should also be attached to that. Yeah. I think we have already talked about policies and procedures. Okay. Now, talking about the risk assessment process. Now, in relation to the risk assessment process, basically we are talking about how the management identifies business risks relevant to preparation of financial statements. We have already talked about it. So, see, in relation to the control system, we need to understand that where is the control required? Wherever you think that something may go wrong. Yes or no? So something which could go wrong, that is where you'll need a control. So now it's important to understand that if as a management, you are not able to identify what could go wrong, will you be able to put the control in place? Answer is no. You'll not be able to do that. Yes or no? You'll not be able to do that. So that's why what is important? Risk assessment is important. Yeah. So risks which are relevant to reliable financial reporting include external and internal events, transactions, circumstances that may occur and adversely affect entities' ability to initiate, record, process, and report financial data. Yeah. So basically, it is covering all of those aspects. Now, some of the risks that can arise or change due to circumstances. Let's try to look at changes in operating environment, changes in regulatory or operating environment. Yeah. New personnel may have a different focus on, or maybe a different approach altogether, or different understanding. New or revamped information systems. So let's suppose entity has set up a new system. Maybe they have implemented a new ERP. So earlier they were following Oracle, now they are using SAP. Okay, so this will again bring in a different set of requirements, and therefore a different types of risks will now be attached to this new system. Yeah. Similarly, new technology, if you talk about rapid growth, so these are some of the examples. Control activities. Now, what do you mean by it? Now, control activities that may be relevant to an audit. So you can say now we are talking about policies and procedures in relation to the performance reviews. Okay. In relation to various aspects, information processing, physical controls, which could be there in the delegation of duties. Yeah. So all of these aspects are covered therein. Information system. Now, what do you mean by information system? See, we are not talking about the IT system. We are talking about this entire system, right? So as an organization, there's always a system which you follow, which is around the flow of transactions. Yeah. So which actually is comprising of two things: physical and hardware components. Then you have the software, then you have various procedures, then you have data which will flow from one place to another. Yeah. So this entire thing, what do you call it as? This is what the information system is. Okay. That's the infrastructure which the organization will set up. Correct? Now, this information system again is important. Yeah, because that's how the transactions will sort of, move across. So the information system relevant to financial reporting objectives encompasses methods and records that identify and record all valid transactions, describe on a timely basis transactions in sufficient detail, measure the value of transactions in a manner that permits recording their proper monetary value in the financial statements, determine the time period in which transactions occurred to permit recording of transactions in the proper accounting period, present properly transactions and recorded related disclosure. See, because now we are talking about the flow of transactions in the organization, which will include all the aspects, okay, which is always going to be interrelated to each other, and eventually monitoring of the controls. Now, this is again a very important part. See, as a management, it's not about just putting the system in place. It is also about ensuring that the system which has been put in place is functioning, is operating in an effective manner. Because otherwise, what is the use of that system? Yes or no? Yeah. So that's why it's again a very important consideration on the part of the management. Because if that is not done, then what do? You actually miss out on the important things. Okay. Or you can say, actually, the risk which you are trying to mitigate is not being taken care of. Actually, you'll miss out on that. Okay. And which eventually will flow into the financial statements in the form of a misstatement, right? Yeah. So that's why there has to be a system of monitoring of the internal controls, which is essential to the organization. Okay. Now, if you talk about this overall system of internal control, so it comprises of administrative control, accounting control, internal checks, internal audit. Yeah. So all of these are what? They are nothing but the ingredients basis which this internal control is set up. Or you can say this is again in a manner constituents of the control system. So internal check system. So for a day-to-day transaction, what should you have? So at least the transaction which is done. So somebody is there to review that. Yes or no? Yeah. For this, there has to be a clarity of responsibility, division of work. Okay, maker checker, very good. So that's exactly the point. There has to be a system, there has to be a policy, which we call as standardization, means the way it is required to be done. Yeah, there has to be a periodic review. Yeah, of course, you'll have this day to day, then there will have to be a top up of the reviews. That's how you are ensuring that everything which is getting recorded in terms of the transactions are correct. Yeah. Then there is another function which you call as internal audit. So what is internal audit? You can say it's a kind of review, or you can say it's a kind of system of reviews which the organization will set up. In this case, what is required to be done? So entire process. So be it related to the financial reporting or other than financial reporting is required to be evaluated, is required to be looked at. Okay. As an organization, if the management wants that they need to have a system, okay, wherein if there are any errors, there are any problems, those are taken care of. They want to strengthen the system. Okay, so it's not only about uh, say finding the problem, it's also about having a system so that the problems do not arise. So there again, this internal audit will help. Why? Because once you review the process in an independent manner, so you also get to know what are the shortcomings. Okay, what is it that needs to be implemented? Maybe some of the improvements which are required to be done. So all of these things is what the internal audit system will help the management to work on. So internal audit system in a way is nothing but an extension of the management. Okay, so it's an independent review, but it's a part. You can say the management is trying to get it done in terms of the reviews through maybe a department of its, which could be in-house or maybe through some external parties. So that's why when it comes to the internal audit, so it's not necessary that it will always be external. There can always be an in-house department. Yes or no? Yeah. So all of these things could be in place. So again, there's no real set formula for this. Right. Now, moving on to this internal control assessment. Now, in this case, what do? You look at each and every aspect of the process. Now, what are the techniques of evaluation of internal control? So now, in respect of the techniques, see different techniques may be followed. Again, depending on the requirements at times. Questionnaire. Now, what is a questionnaire? So you can say it's a set of questions which is aimed at achieving a desired outcome. Okay. So now in this case, what do you have? You will have a set of questions which you will go ask. Okay. So you can say it's more of inquiries that you will do through those questions so that you are able to, first of all, understand completely in terms of the process which is there. And of course, you also get to know as to if there is any problem in relation to that particular process or system. Yeah. Now, Swaminathan mentions list of questions prepared to check objectives of the internal control. Yes, of course, that's correct. Yeah. Now, there's another thing which you call as checklist. So what is a checklist? See, in case of a checklist, we are talking about a series of instructions or the questions on internal control, which the auditor must follow or answer. Okay. So it's a checklist, which again will have a set of questions. But over here, the auditor will have few options, okay, which is generally about yes, no, or not applicable. Okay. So you can say in a way, these are the questions which are having the responses in the form of drawing the conclusions. Why? Because some sort of understanding you can obtain the way the questions are framed. So that's why you will be looking at as to whether it's there or not, whether it's being done or not. Okay, so unlike a questionnaire wherein you can just go descriptive as well, right? So it's more of a checklist for the auditor to fill. So for example, have you checked that the cashier is not responsible for opening the incoming mails, does not authorize any of the ledgers, does not authorize any expenditure receipt? Yes, this is what you'll have. So for which the answers will be either in yes, no, or any. So there again, if any sort of explanation is required, there will always be a column for remarks, which the auditor can go and fill. Yeah. But you may also be thinking as to, how is it different from questionnaire? See, actually, most of these things are largely similar. Then you have this flow chart. Now, what do you mean by flow chart? See, flow chart is all about, you can say, a way of understanding the flow of transactions. See, there are two ways you will understand the flow of transactions. One, you look at the SOPs. In the SOPs, so it will be all put down on a piece of paper as to how the transactions, how the processes are working. Okay, which is more of descriptive in nature. But if let's suppose that has been put down in the form of a flow chart, okay, so it's not the description which is given, but you can say in a way that description is captured in the form of a flow chart by having a flow chart in place. So in such a case, once again, the objective of understanding is achieved, but the auditor over here will be able to quickly understand. Okay, so you can say it's more presentable, it helps the auditor in understanding the flow of the transactions. Yeah, so if you look at this flow chart, for example, yeah, so you don't need to get into that descriptive document to read, or even if you get that, you will get some more clarity. Okay, yeah, because it's more of a pictorial presentation of the way the function is going on, maybe the way the process is actually flowing in the organization. Okay, yeah. Now, so if you look at some of these are nothing but the flow charts, and I would advise if you can just also go through some of these flow charts. Okay, so you get a quick perspective of what is there, how the things are flowing. Okay, now reporting to the clients on internal control weaknesses. So this is largely about the reporting requirement, and I'll come to that slightly later. Now, frameworks of internal control. Let's try to understand that. Now, what are the frameworks? See, there are different frameworks basis which some of these control systems which are required to be put in place. Okay, they are looked at. So you have this COSO, which is you can say the international framework. So some of these things become important for the auditor to be considered. Now, once again, over here, what is the objective of the auditor? Objective of the auditor is to reach the same point. Yeah. And what is that? To ensure that the risk of the auditor is minimized. Okay. So that is actually the objective. Now, in this case, now what is the risk? Broadly, probability of occurrence of any undesirable event or circumstances. Now, who can be at risk? Of course, it could be the client, it could be the audit firm, or the engagement partner itself, right? So, some of these things I think we have already talked about. Now, risk assessment, if you have to just quickly summarize this risk assessment approach. So, it has to begin with the understanding always. And on the basis of the understanding, what do? You will first of all identify and then get on to the detailed assessment. Correct? Yeah. Now, once you have this risk assessment in place, what do? You will want to mitigate those risks. Okay. So for which a lot of activities you will do, you will also be looking at the control system, some of those things which are there in the organization. Right? Okay, so now what we can do is just give me a minute. All right, so now what we can do is now we can also talk about another very important consideration, and that is about materiality. Okay, now materiality again is a very important aspect for the auditor to consider. Okay, but I think what we can do is maybe we can take a break now, and after the break we will continue with our discussion on materiality. Okay, yeah. All right, so Manish, we can take a break now. Yeah, so let's meet after 15 minutes. Huh? All right. Okay, so now we'll talk to, sorry, so now what we'll do is we'll just get on to this next point, that is around materiality. So just give me a minute, I'll just share the presentation for this. Okay, so now materiality. Now again, see, when we talk about materiality, so basically, once again, we are talking about the planning part, right? So now what is materiality? Let's try to understand about the materiality. See, materiality is all about the significant items. Okay, or you can say the significant errors which could be there in the financial statements. Why? Because there's a certain threshold which is considered to assess a particular amount. So that's how you call it as a significant item or a significant error. So that's one basis for one to look at. And in terms of qualitative aspect as well, materiality may have to be considered, wherein you don't go by the threshold. You may be looking at various factors which are important. Now, important thing is that what is the meaning of this materiality? So anything which can influence the decision making of the users of the financial statements. Okay, so that is what you call as material. And if that is missed out, that is what you call as, again, material. Okay, and that will be a material error. So now, in the context of audit, how is that relevant? We need to go to the audit objective. So the audit objective requires auditor to ensure in a way that any material misstatement should not remain in the financial statements. Yes or no? Yeah. So this is the objective with which the audit is conducted. Okay. So that's why it's important that auditor is ensuring that material misstatements are not there. If let's suppose misstatements are there, but those are not material. Yeah, those are not so significant in terms of amount. So will that be of will that be of any concern to the auditor? The answer is yes, but not so much as far as the reporting is concerned. Why? Because to have an error or for an error to be there shows some sort of problem, yeah, in the systems. But if that is not significant enough, so we can say the auditor can live with that. Yeah, because that's not really defeating the objective of the audit. Now, there are few reasons we have talked about as to why this materiality is required to be looked at. Where is it really relevant and in what context? Okay. Now the question arises that if this materiality is something that you plan to use, so where do you use this? So at all stages of audit, this is required to be used. Why? Because this entire audit has to be done on the basis of what is significant and what is not so significant. That's the approach we have been talking about, isn't it? Now, how do you determine what is significant? What is a material is what will you have, is what will help you in deciding what is significant or what is not so significant. Okay, so therein this aspect becomes important for the auditor to consider, for the auditor to look at, right? Now, when we talk about planning stage, so in case of planning stage, materiality is important. Because in terms of planning, auditor will consider what is a significant risk area, and that's how the auditor will be deciding the audit procedures. He'll be working on the audit procedures. Eventually, when the auditor will start the execution, he'll get onto the substantive audit procedures. There again, when it comes to sampling, when it comes to some of the areas to be focused upon. Okay, why? Because he'll not be able to check everything. So that's why there again he'll need a threshold, which you call as materiality. Yeah, so that becomes the basis for the auditor to perform the audit procedures. When the conclusions are drawn, if let's suppose auditor will come across errors, so some of those errors which are not material, auditor can ignore that. That is not going to have any impact on the audit side. Yeah, so that is something he can always live with. When it comes to the reporting, so now in respect of that reporting, auditor will have to consider what is material, what is a material misstatement, and whether that is continuing in the financial statements or not. Yeah. So now materiality is important. Why? Because if that is too low, so the auditor may end up checking a lot of things. So you can say the extent of audit is something which is driven by this materiality. So if let's suppose you pick up a threshold, so let's suppose for a large company, you pick up a threshold of say 50,000 as materiality. So you end up checking a lot of things. So in a way, you are doing over audit, which is not an efficient way of doing the work. Similarly, if you pick it up at a very high level, then definitely there's a risk. What's the risk? That some of those misstatements which you may be ignoring. Why? Because you are considering those are below threshold, are significant enough for the business, and which should have been addressed. Okay, which should have been taken care of by the auditor, but the auditor may be skipping that. Yeah, so basically we are talking about inefficient or under audit, which is again not something which the auditor will desire to achieve. Now, as around this materiality, so basically it's a threshold. Okay, so now for this materiality to be determined, actually we are talking about a threshold to be determined. So there are some benchmarks which are available, basis which this materiality is required to be determined. Now, what are those benchmarks? So we can say some of the benchmarks could be the profit, revenue, assets at times. Again, there's no set formula for this. And that's why we say that it's on the professional judgment of the auditor. See, definitely there are some factors which the auditor will consider on the basis of the nature of the business, on the basis of the nature of the industry, on the basis of the size and complexity of the organization. But there are definitely certain factors which will be dependent on the professional judgment of the auditor. Okay, which will drive this determination of materiality. Yeah. So some of these elements, I think like Saminathan mentioned, of financial statements. Yeah, of course. So you look at all of this elements, or I would say a financial statement as a whole. But when you have to determine the materiality, so what will become the benchmark? That's one. But the consideration has to be very clear that actually we are trying to reach a number, okay, above which if anything is missed out or if anything is erroneous in the financial statements, that is something which should be corrected. Correct? Yeah. So a lot of factors are required to be considered in this case. Now, if let's suppose the business has a profit, consistent profit, or you can say the profit growing at a constant rate, okay, largely in line. So the profit can be the benchmark. But if let's suppose there are volatilities that you see in the profitability of the companies, the profits are there, but there's a lot of volatility. So in such a case, the materiality that you determine on the basis of profit, will that be appropriate year on year? May not be appropriate. Yeah, so that's why you may be looking at different benchmarks. See, generally, this profit as a benchmark is considered to be the most appropriate one, but this doesn't really fit the requirements at most of the time. So materiality is calculated by selecting a suitable benchmark. Okay. And applying a reasonable measurement percentage. Okay. Now, what could be the benchmark in some of these scenarios? Let's try to understand this. For the commercial entities which are having profits, PBT is generally what you will prefer. For the public companies, for the listed entities, what is the benchmark? Again, PBT is what you will consider. But if let's suppose company has profits year on year, but there's volatility in the profits, means in a particular year profit percentage is 1, next year they have 10%, next year they have 15%, then they have 3%. Okay, so the volatility is what you see in the profits. So in such a case, do you really go with this PBT? Answer is no. Either you will normalize the profits if that is achievable. Otherwise, the better benchmark in such a case will be to move on to the revenue. Okay. So when we say benchmark, means you will keep that as the base for computing that threshold. Okay. Now, if let's suppose there are entities that are at break-even levels, again, the profits are missing. So if the profits are missing, so what do? You'll have to look at the other benchmarks, possibly revenue. Again, if the revenue is again not consistent, if there is again a sort of volatility in the revenue that you observe, okay, upside, downside, every time you see there's sort of volatility. So where do you go? Total assets is what you pick up then. Okay, so that can also be one of the benchmarks. What if the entity is reporting losses? Now that could also be a question mark. So should we say that loss will become the benchmark? Yes or no? So that could also be a question, that an entity is making losses. Okay, so in such a scenario, what do? Right? So there again, you will not pick up the loss as the benchmark. So there again, you'll have to look for other revenues and revenue and total assets, yeah, which are generally preferred. Now, depending on the way an entity is structured, should that also have a bearing on the consideration of the benchmark? The answer is yes. Absolutely yes. So the way an organization is structured will also play an important role in deciding the benchmark. Again, we are not talking about the threshold or the percentage of that benchmark you'll consider for computing that. No, we are not talking about it. We are talking about the benchmark that you will pick up. Okay, so the possible benchmark that you will take in such a scenario. So what do you do in such a scenario? There again, you will generally go by the total assets or the revenues. Why? Because therein the profit number may not be good enough or may not be appropriate for you to pick up as the benchmark. Now, there could be some organizations which are not for profit. Okay. So, in such a scenario, what do you do? There again, you go by revenue or total assets. Now, what do you do in case of the entities which are in the nature of financial business? Okay, so what do you do that? So, there again, you will have to look at some other revenues. Okay, and in most likelihood, you will pick up total advances instead of really going by total assets, because advances is an important area, and you can say a major chunk as far as the total assets are also concerned. So that is something you will prefer. But of course, there are a lot of factors you will consider. Now, now comes the question that if you have to pick up a benchmark, so how do you reach that amount? So there is a possible range that you will consider, right? So this measurable percentage or the possible range is something you'll have to decide. Now over here, there is no clear answer you may get. Okay, to say that there is a formula for this exact percentage to be picked up, is that possible? No, that is not possible. Okay, so this will require judgment. And this will again require judgment to be applied based on certain factors. Okay, so here again, certain factors will have to be considered by the entity. Now, if you look at this PBT, so we can say it ranges from 3 to 10 or maybe say 5 to 10. So when do you stay in the lower range? So you'll want to stay in the lower range when you want your threshold to be lower. Means if you want to keep your materiality at a lower amount, so what will you do? You will stay at a lower end. I'm not saying it will be the lowest one, lower one. And as you move further, what will happen? You will actually be moving at a higher number. Yes or no? You'll actually be moving at a higher number. Now, in this case, one of the factors which you may consider for the lower range, for the higher range, will be the control system, which we just talked about. See, for an organization, just think about it, wherein you find the controls are strong. So as an auditor, your comfort level will increase. And let's suppose you have another client wherein the systems are not strong. In fact, the systems don't exist. Okay, you find problems. Generally, you find errors. In fact, a lot of errors during the course of your audit. So you understand that there are chances the errors will be there. So that's why, what will you want to do in such a situation? Because your comfort level is not there. So that's why you will want your materiality amount to be lower. Okay. As against a company wherein the controls are strong, wherein you'll say that I don't need to look at a lot of things. So that's why you'll want your materiality amount to be higher. Right? So you can say this could be one of the factors, but again, this is judgmental. And of course, the range is available, so you need to stay within that range, but this is judgmental. This is on the basis of the judgment and a lot of factors for the auditor to consider, right? So there are a lot of factors we have already discussed, which will decide the benchmark, which will also help the auditor to assess, correct? Now what we can do is we can just quickly look at this example. And with the help of this example, we'll just try to look at some of the questions around it. ABC is a company providing IT services across different sectors. The company is specializing in providing solutions through AI. Major clients of the company is from BFI sector. Company is listed on the stock exchanges. So the profits are given, revenue is given, total assets are given. Year on year profits of the company are growing at average rate of 8 to 10%. But in the current year, an impairment loss is recorded amounting to 200 million, which is adjusted in the above profits. Company over the past years has maintained a good dividend payout ratio, and the investors derive their return on investment from this. Okay. Now in this case, what is the most appropriate benchmark? Profits, as the investors and management are more focused on it. Adjusted profits, just to adjust that with the impairment loss to normalize it. Total revenue, because it's consistent year on year. Total assets, or you believe no, the given benchmarks are not the appropriate one. So there's something beyond that you'll want to consider. Yeah. So in this case, what would you consider? So Swaminathan says B. So let's understand in this case, what will you do? You will definitely want to go with profits as a preference, but over here, the normalization is required, correct? So now, calculate materiality for the financial statements as a whole. So there again, because you're normalizing it, so you can do some sort of calculation and compute it, which remains quite subjective. Would your materiality change if the company is a closely held private company? So what do you think? Depending on the way the organization is structured in the given scenario, do you think your materiality is going to change? What do you think? The answer is yes, clearly. Yeah. So we are not saying it will always change or it has to change for sure. But the point is that will that become a factor for you to consider? Answer is yes. That factor will always be there. Now, as regards this materiality, see here again, what do you have? We can say there are three ways the materiality is required to be looked at. So one, or you can say the larger term that we use is called as materiality. Okay, something that we have been discussing. Then we have this term that you call as performance materiality. Now, what is the meaning of performance materiality? What is the relevance of this? Okay, so we'll talk about this performance materiality. And then of course, we have this another threshold. So we can say basically there are three thresholds, and we have this another threshold called as trivial. Okay, or you can say this is also at times called as de minimis, or sometimes this is called as clearly trivial threshold. Yeah, so it's known by different names, but all of these things are actually one and the same, right? So now comes the point that what is this materiality? See, materiality is the term that we have just discussed. Okay, yeah. So materiality is not something that is different anywhere for the purposes of our discussion. But definitely there is a term called as performance materiality, which is something for us to consider. Yeah, so that's important. Now, what is performance materiality? If let's suppose materiality is 100, so we can say there is another threshold which is required to be considered, which is lower than materiality. Okay, which is lower than materiality. Now, how is this relevant? It's relevant in respect of the undetected misstatements. We just talked about audit risk. So there is a risk that the audit procedures may not be able to help the auditor to identify material misstatements at times. Correct. So what will happen to those samples or the part of the population which has not been tested by the auditor? Are we 100% sure that the part which has not been tested by the auditor is free from material misstatement? Answer is no. Answer is no. Right? Therefore, what the auditor will do is, auditor will want to give himself a room in respect of some of those misstatements which may be there in the financial statements, but which the auditor may not be able to detect. So that's why what the auditor will do is, auditor will pick up this performance materiality so that there's a cushion of 20. Yeah. So this cushion is given to address, or you can say to incorporate those misstatements which may have been there, but which go undetected by the auditor. So that's why the threshold which the auditor will consider will be what? Performance materiality. Okay, and eventually we have one more threshold which you call as trivial. Okay, or we can say clearly trivial threshold. Now you can say it's a very small amount below which, if there are misstatements, or even if you can say there are accumulation of misstatements, those can be ignored. Why? Because this is too low a number for the auditor to consider. Why? Because any of these misstatements which are below this trivial is not going to have an impact, is not going to really lead to a material mistake. Okay, so now all of these things are important. Why? Because they will help the auditor during the course of audit in terms of designing the audit procedures and of course the performance of those audit procedures. Right? Now, let's look at some of the situations as to how this will have an impact on the audit side. Increased risk of misstatement arising from introduction of a significant new accounting system potentially affects multiple classes of transactions, account balances, and disclosures. So what will happen? So this will definitely decrease, lead to a decrease in the materiality. That's what the auditor will want. Numerous misstatements were identified in previous audits. And there's also an identified risk of material misstatement due to fraud. Yeah, so what will the auditor want to do? Auditor will want to decrease the materiality threshold. Few misstatements were identified in prior audits. Internal control system is strong. Operations are stable. Entity also, if you look at their business. Okay, so they operate in lower risk industry. So in this case, what will the auditor want? Auditor will want to increase the materiality threshold. Correct. Next, misstatements identified in prior audits, generally arising because the entity is small and the accounting staff is under-resourced, which prevents the entity from designing and implementing effective controls. So decrease clearly, right? Now, please remember that materiality is a part of a planning exercise. And for the planning also, we have discussed that planning is not something which you will just do and you will forget. Yeah, so it's something which is a dynamic process. So you need to keep wary of the facts which may require some sort of changes during the course of audit as well, despite the audit plan, okay, audit program that you may have. Okay, so in such a case, what is important? It is also important that the auditor reassesses the materiality wherever that needs a change. So the point is that everywhere this will not be required to be changed. Okay, and everywhere you don't keep reassessing that. But of course, if there is any factor which requires this to be maybe increased or decreased, so that should be done. Yeah, so that should be done. So that's an important part for the auditor to consider. Okay, now in what situation should an engagement team consider whether revisions to materiality are important? Entity has substantial sale in fourth quarter that was not initially anticipated in the planning financial information that was used to determine materiality initially. So one of the reasons. After determining materiality, team discovers any material error due to reconciliation difference. Entity disposes of key part of its business after the determination of materiality. Yeah. So there again, you need to look at some of these factors as to which are going to be really relevant. Okay. Now, documentation, I think we have already talked about it as to how is this relevant, where is this relevant, and if at all that is relevant or not relevant. Correct. So now what we will do is, now I think we can pick up questions. Okay, some more for the purposes of our discussion in relation to some of these things we have covered, right? All right, so let's look at this. CAR is conducting statutory audit of a divisional office. Okay, it's a public sector insurance company for which the audit is being done, right? On going through delegation of powers, delegation of powers means, you can say again in relation to the job responsibility in terms of the activities, who is required to do what all, uh, approval authority somebody is having, what all execution requirements, responsibilities somebody is having. Yeah, so all of those factors are required to be looked at. So on going through the delegation of powers laid down by the company's head office, it is noticed that surveyors in claims under the property insurance policies beyond estimated amount of 30 lakhs are to be appointed by divisional claims committee. Okay, so the surveyors require appointment if, let's suppose, the amount is beyond 30 lakhs through this committee, DCC. However, on going through surveyor appointment details, so when the details of their appointment were checked, of 10 such claims during the year, 5 instances have come to the notice of the auditor where the above delegation of powers has not been followed, and the appointments were made by the divisional manager in place of this committee. Okay, so you can say this authority matrix which is available, that was not followed by the company in 5 instances out of 10. Okay, now this is again important, that 5 out of 10. See, why is that important? Because you can say there are a lot of instances. In the beginning, auditor had assessed risk of material misstatement to be low. So you can say when the audit was planned, risk of material misstatement was kept at a lower level. Yeah, that must be on the basis of the initial thoughts. Describe why the above finding would change assessment of the auditor in relation to the above. In fact, I have a couple of questions here. Whether this above finding, okay, wherein you find the company is not really following the authority metrics, should lead to a change in the auditor's assessment? Number one. If yes, why? Okay, so that's how I think we can really put it. Okay, yeah. So Saminathan, would you like to have some thoughts on this? Any thoughts you like to share on this?
Yes, sir.
Yes.
The auditors, that main thing is that he need to assess the risk of material misstatement.
Hmm.
And material risk misstatement here is it is particularly on the control risk. The
Right.
delegation of powers is given to DCC,
Right.
but wherein that 5 instances is not
Right.
appropriately approved by the DCC. It is given to the divisional manager in the place
Right.
of DCC.
Right.
In the case when that matter is given to below the level,
Hmm.
but the delegation deviation will be there. I think it can be given. However, that fundamental procedures, what is to be
Right.
checked, where to be checked, on what duration, which time to which time the delegation is given, about the it has to be duly approved,
Right.
and based on that they can go for that deviation approval. Based on that they
Okay.
can do the approval control.
Okay.
Alternatively, after he assumed the position, he need to revisit and check that as well.
Right.
But such deviation, it should be the established control.
Okay.
And to conclude that, yeah, this is the nature of timing and situation. Based on that, if not followed in such a way that, then definitely an auditor can look into increase the material that he assessed the low level,
Hmm.
then definitely he can increase the level of materiality recheck with respect to the aspect and conclude it accordingly.
Right. Sure. All right. So let's look at this. See, when we talk about evaluation of internal controls, so that definitely influences the auditor's assessment of risk of material misstatement. Why? Because when we talk about risk of material misstatement, it has an element. What do you call it as control risk? Okay. In the given situation, what has happened? So this procedure related to delegation of powers, this has not been followed, right? Should we say it's a concern? Yes, it's a serious violation as far as the control procedures are concerned. Controls are not operating in an effective manner. Okay. Therefore, should it require a reassessment of the risk of material misstatement? Answer is yes. Yeah. Okay. So thereby, what will happen? The auditor will have to again, you can say, rethink the audit strategy in the light of this extent of audit testing, in the light of this problem which has come across. Yeah, because these may be only 5 instances, but what if you increase the testing? You may come across various other situations. Okay. Now, RK Living Limited is engaged in manufacturing and processing of textile fabrics. It purchases its raw material from a company based in Silvassa, taxable at the rate 12%. Okay, so what is the nature of the business of the company? It's the manufacturing and processing of textile fabrics. So that's the nature of the business. Okay, it takes about 3 to 4 days for the raw material to reach the company's plant. So they are importing and recently the company has revamped its internal control system for recording the transactions. So there's a revamping in the internal. So it means there are some changes. Okay, those changes are significant. That's why we call it as a revamp. You have also assumed charge as the head of internal audit department of the company few days ago, right? So now you happen to be the internal audit head. It is noticed that information system requires booking of purchases in purchase ledger and stock records from the date of purchase invoice only. So the current system that the company is having, what does it require? Booking of purchases in the purchase ledger and the stock records. Of course, you will record purchase, you will increase the stock, yeah, from the date of purchase invoice only. Okay, let's suppose the date of purchase invoice is 19th November. You actually receive the material, say on 25th of November. So what do? You record it on 19th November. How would you deal with the above matter as an internal auditor of the company? Okay, yeah, clear? So how would you deal with that? Yes, any thoughts, Saminathan? If you have any thoughts on this?
Yes, sir. Here, that they revamped the internal control system. Their policy, see, as far as the internal audit function is that they are evaluate that internal control, and it will provide the assurance to the management how it designed, how it is implemented, how it is operating effectiveness. All these things, it's a part of the internal audit function.
Right,
See, and also it will do the, if the internal audit is a continuous process within
right,
the organization. Either it
right,
can be the internal auditor or external internal auditor.
right,
Here the thing is that he noticed that the booking of purchases in the purchase ledger and the stock record from the date of purchase invoice only, which
Okay.
is at least totally not in order actually. First, the thing is that they have to receive the stock, then it is to go into the stores, then only on the goods receipt note, then it will move the purchase invoice, then only it has to be booked in the purchase ledger.
Right.
And if some goods in, say example in transit is sometime what will happen is the goods is purchased from long distance,
Right.
it may not be reached on time. The before that the
Right.
purchase invoice will reach.
Okay.
And nowadays electronic way means and is there. So in this
Yes.
case also there is a problem. So I think that totally the design and the implementation by the internal control, which is totally is not in order,
Right.
that it has to be bring into by the internal auditor and it has to
Hmm.
be reported to the management as appropriately.
Okay. Sure. Good. So I think what we can now do is we can just now look at some of these requirements from the internal audit's perspective. Internal audit involves continuous and critical appraisal of functioning of an entity. Now, in this case, the idea is not only to review as we discussed. Yes or no? Yeah. Idea is also to suggest improvements thereon. Okay, so that's what the internal audit is all about. Further, idea is also to add value to and strengthen the overall governance mechanism of the entity, including its strategic risk management, internal control system. Internal audit also involves evaluation of internal control to provide assurance to the management regarding design, implementation, operating effectiveness of control. In the given situation, information system requires booking of purchases in the purchase ledger and the stock records from the date of the invoice. Such a control system is likely to present a distorted picture of the stocks of the company very clearly, because you receive the material on 25th, but you record it or you show this in your records as if it was there on 19th. Okay, which is not appropriate. It would show the stocks of raw material as received, whereas these goods could be in transit at that point of time. Okay, they may not have been received on that particular date. Therefore, the design of the control itself in the given scenario is clearly faulty, which allows booking from the date of purchase invoice only. Further, a system can have implications if you look at it from regulatory perspective as well. Okay, for example, GST laws, okay, which may create problems for the company as far as the compliances of relevant laws and regulations is concerned. So the internal auditor should report on the above matter, asking the management for corrective action. Correct. So this is what the internal auditor should be doing. Next. Okay, so let's look at this next one. A company, as a part of its internal control setup. Okay, so now we are talking about the internal control system. Okay, so there was a system under which quarterly budgeted targets in respect of sales are analyzed with respect to actual performance achieved. So what do they do? So every quarter, for every quarter, they have the budgets in respect of sales. So it seems they are preparing the budgets, and then the actual performance is also reviewed vis-a-vis the budget which was in place. Okay, whether the actual performance is in line with the budget. Okay, okay, what are the deviations? So it appears they are doing this exercise, which is important, and that's why you have the budgets in place. Otherwise, what is the purpose of a budget, right? It also involves fixing responsibilities of different product departmental heads and taking timely correction. Okay, so now they are also assigning this responsibility to the product departmental heads, because that's how you will be able to achieve this. Yes or no? In case of product departmental heads not achieving the quarterly budgeted targets, they are required to give a detailed justification as to why that has not been achieved. Of course, this is what you'll do. Okay, only then you will be able to understand the reasons for variance and whether the budgets were really appropriate or maybe the budgets were faulty to begin with. Okay, and in this particular analysis, there will also lay down how the shortfalls would be compensated. If let's suppose there's a shortfall, should we catch up in the next quarters in respect of that shortfall, or will that catch up not be possible? Identify and explain component of internal control alluded to in above scenario, right? Yeah. So once again, any thoughts on this, Saminathan? Any thoughts
Yes,
you'll
sir.
have? Yes.
Yes, sir. We have studied about the five internal control component
Right.
in which the control environment risk assessment and the
Right.
information and
Right.
also control activity monitoring the control. I think it's a
Right.
part of the control activities.
Hmm.
In the control activities, we have to look into the past budget and what it is. We need to analyze that information. What is
Right.
the actual performance against the last one,
Right.
and whether it is achieved as per the target date. All the things they have to look into it on this case.
Right.
Department head, why it is not achieved? What is the reason behind it? It has to be analyzed
Right.
in detail. Is there any mistake on
Right.
this? It has to be detailed check, sir.
Right.
It's a
Okay,
part
good.
of control activities.
Sure. Sure. So let's look at this. See, the above referred component of internal control is what? Control activities. Control activities that may be relevant to an audit include policies and procedures that pertain to performance reviews. Yes or no? Such control activities include reviews and analysis of actual performance versus budgets, forecasts, and prior period performance, relating different sets of data, operating or financial, to one another, together with analysis of the relationships and investigative and corrective actions, comparing internal data with external sources of information, and review of functional or activity performance. Okay. The control activities pertaining to analysis of budgeted target of sales with respect to actual performance, fixing of responsibilities, taking timely corrective action falls in the nature of performance reviews. Clearly, such performance reviews are what? They are nothing but a part of control activity. Okay, and control activity is what? Which is a part of internal control. Right. So I think the question was really focused around the component. Okay, so they are trying to test you what component of internal control is being discussed. Okay, so that's why it's important for you to have a clarity in terms of what the components of internal control are in the context of different situations which would be there. Okay, now let's look at the next one. CAS, it's is the statutory auditor of a listed company. On reviewing internal controls of the company, he is of the view that there can be possible situations where insurance premiums for keeping insurance policies current in respect of various assets of the company may have become due and payable, but internal control systems established by the company may not be able to capture it. Okay, yeah. elaborate how he should proceed to deal with the above matter. Yes. Once again, any thoughts on this?
So actually, the purpose of the internal control, they have to design and implement and check that of operating effectiveness. For
Right,
that, they should have that proper design and policies and procedure
right,
to guide that.
right,
And here the deficiencies are exist. In
right.
this case, that auditor definitely, as a part of statutory auditor, he has to find out what is the weakness and the deficiency involved with respect
Right,
to the internal control, with respect to
right,
the premium insurance policy. He
right.
has to identify and provide that what it is, what the nature of that deficiency, and what is the possible and the possible solution also. He can put and communicate to the those charged with governance as or management as appropriately.
Yes. All right. So let's look at this. So what is really the basis you'll follow? So a deficiency in the internal control exists when a control is designed, implemented, or operated in such a way that it is unable to prevent or detect and correct the material misstatements. Okay. Or a control necessary to prevent, detect, and correct misstatements on a timely basis is missing. Yes or no? In the above situation, now what do you find? There is a possibility that the internal control systems established by the company may not be able to capture the insurance premiums which have become due and payable. Okay, so that's what the question says, that it may not be able to capture. So is that a risk? Answer is yes, it's a risk. It's a significant deficiency, as failure to keep insurance policies current would render the assets of the company uninsured. Yes or no? Yeah. It may lead to losses for the company in case of any eventuality. Further, in accordance with SA 265, significance of a deficiency or combination of deficiencies in the internal control depends not only on whether a material misstatement has occurred, but also on the likelihood that a misstatement could occur and the potential magnitude of the misstatement. Yes or no? Because we are not talking about a situation that, yes, the problem has actually come. What if the problem can actually come and possibly the way which the or the possible ways to prevent that problem from happening, from its occurrence, do not exist. So that is also a deficiency. Yeah? So significant deficiencies may therefore exist even though the auditor has not identified misstatements during the audit. Correct? The susceptibility to loss of an asset is a factor in determining whether a deficiency constitutes significant deficiency in the internal control. Auditor shall communicate in writing significant deficiency in internal control to those charged with governance and include in the written communication of significant deficiencies in internal control. Now, what will he communicate in writing? Description of the deficiencies, and of course an explanation on their potential effects. See, if let's suppose the auditor is talking about a significant deficiency, then its potential impact is this something which becomes important for anyone to understand. Correct? Sufficient information to enable TCWG. What is those charged with governance? TCWG. Okay, TCWG. So sufficient information to enable TCWG and the management to understand the context. So it's very important the matter is explained. Okay. So they can understand as to what is required, what is really being discussed. Yes or no? Yeah. All right. So let's look at the next one. CAB was appointed as the auditor of ABC Limited. Okay. So now we have this financial year 23-24. And it appears it's a new auditor. So it's appointed. So we are assuming it's new auditor. During the course of planning for the audit, CAB intends to apply the concept of materiality for the financial statements as a whole. Very good. So that's something which is required also. Please guide him with respect to the factors that may affect identification of appropriate benchmark for this purpose. Okay, so now we are talking about factors that may affect identification of benchmark. Okay, what all factors you will consider? That's one. Okay, so I think first of all you have to give the guidance, the relevant guidance around it. Then, what benchmark should be adopted by CAB if ABC Limited is engaged in manufacture and sale of air conditioners and is having regular profits? Then I think some of the situations have been created. Okay, so considering that situation, we need to comment as to what will you do in terms of selecting a benchmark. Okay, so if let's suppose the nature of the business is what, manufacturing and sale of ACs, and they are having regular profits, means the profits are quite stable. Okay, so which benchmark you'll select? If let's suppose the company is engaged in construction of large infrastructure projects, okay, and incurring losses, and it's been 2 years due to pandemic. So in such a case, what do you do? Right. So I would say there are three parts to this question. Okay. So part A is when you talk about the guidance, then of course, part B, which comprises of two situations. Okay. So B1, what do you do? B2, what do you do? That's all in all, these are the three parts to this. Okay. So I think let's talk about the guidance around it. So what all factors you will consider? Use of benchmarks in determining materiality for the financial statements as a whole. So what is that? So we have this SA 320, okay, which talks about it. Now, as per SA 320, determining materiality involves exercise of professional judgment. I think this is the most important consideration. See, it's a matter of judgment. That's the first point we need to consider. A percentage then is applied to a chosen benchmark as a starting point in computing the threshold, you can say. Okay, so any threshold, any benchmark you'll have. So what do? You'll pick up a percent of that, and that's how you'll get the threshold, because it's all about quantitative number that we are looking at. Okay. Now, what are the factors that you will consider which will have an impact on the identification of appropriate benchmark? One, elements of the financial statements. For example, assets, liabilities, equity, revenue, expenses, all of these things you will consider in terms of their size, in terms of the amount involved. right? Whether there are items on which attention of the users of particular entities' financial statements tends to be focused. For example, for the purpose of evaluating financial performance, users may tend to focus on profit, revenue, or net assets. Yes or no? Yeah. So, what do you do in such a case? Nature of the entity. That will also be one of the very important factors where the entity is at in its life cycle and industry and economic environment in which the entity operates. Okay. Entity's ownership structure. That again is important factor. The way it is financed. It is financed solely by debt instead of equity. Users may put more emphasis on assets and claims on them, and then of course on the entity's earnings. Okay. And relative volatility of the benchmark. So that will also be one of the factors. Correct. Now, determining a percentage to be applied to a chosen benchmark involves exercise of professional judgment. See, first of all, to identify, to select a benchmark, you need judgment. This entire exercise is something which will require judgment. And then if let's suppose you select a benchmark, then what percentage you will select? You will select 5%, 6%, 1%, 2%. So what percentage do you select? So that again, there is no clear answer to this. You'll have to again look at some of those factors. Okay, basis which you will select a percentage. So there's a relationship between the percentage and the chosen benchmark such that a percentage applied to profit before tax from continuing operations will normally be higher than percentage applied to total revenue. Of course, why? Because in any organization, the revenue amount will be a significantly higher number as compared to the profit amount. Yes or no? Yeah. Now, we are given two situations. So what was the first situation? If the company is having manufacturing and sale of air conditioners and the profits are stable, in such a case, what is the benchmark you would want to select? I think it's clear. It has to be PBT. Because if the profits are stable, so you'll definitely want to go with profits. So which is nothing but PBT. Correct? Now, another situation. If let's suppose company is involved in construction of large infrastructure projects and is incurring losses, so the profits are missing. Yeah. So whatever be the reason, profits are missing. So can the company really go by PBT? Answer is no. Now the PBT is gone. So in this case, auditor will generally consider revenue or gross profit as benchmark. Right? Alternatively, CAB may consider the criteria relevant for audit of entities doing public utility programs, total cost or the net cost. Okay, that may also be an appropriate benchmark for that particular program or the project. Where an entity has the custody of the assets, asset may be an appropriate benchmark. Okay, right? Clear? All right, so now let's look at the next one. New Life Hospital is a multi-specialty hospital which has been facing a lot of pilferage and troubles regarding their inventory maintenance and control. So seems there's a problem in terms of their inventory. So this inventory management is a concern, because if there's a pilferage, so it's a serious concern actually. Okay. Now, on investigation into the matter, it was found that person in charge of the inventory inflow and outflow from the storehouse is also responsible for purchasing and maintaining the inventory. Okay, so you can say sort of dual responsibility has been placed, or you can say multiple responsibility. So a person is single-handedly doing all of things, okay, which are related. So seems he has got control over this entire process, which is inappropriate. So clearly, you can say control system is not put in place in terms of the design itself. Forget the implementation. Which basic system, according to you, in relation to the internal control has been violated? Also list down the other general conditions pertaining to such system which needs to be maintained and checked by the management. Okay, now basic system of control. Internal checks and internal audit are important constituents of accounting controls. Internal check system. So what does it imply? It implies organization of overall system of bookkeeping, arrangement of staff duties in such a way that no one person can carry through a transaction and record every aspect thereof. Okay. In the given case, person in charge of the inventory inflow and outflow from the storehouse also purchases, maintains the inventory records, right? Thus, one of the basic system of control, that is internal check, which includes segregation of duties or maker and checker, has been violated, where the transaction processing are allocated to different persons in such a manner that no one person can carry through the completion of a transaction from start to finish, or the work of one person is made complementary to the work of another person. The general condition pertaining to internal check system may be summarized as under. So let's understand what is that. No single person should have complete control over any aspect of the business operation. So that is what you will always expect. Yeah. So that's how you will put the control in place. Okay. So if let's suppose you have two persons, one doing the work, second doing the review, or maybe there is a breakdown of a particular activity into various parts, and some of the part is done by one person, some of the part, so in a way you are putting a control. Yeah, because one person is not responsible, so end to end you are not given to one person. Okay, that's a very control in it, very important control. Every employee's action should come under the review of another person. Okay, so that's the basic necessity, or you can say the basic requirement with which the control is always established. Staff duties should be rotated from time to time. Okay, for example, if you look at banks, okay, so we are all familiar with banks. So you visit any branch of bank. After some period of time, what do you see? A person who was doing some work, now he has been assigned some other work. Okay, so there's a shift in the job responsibilities. Okay, they are also moved from one branch to another. So what is that? That is nothing but a system of control they have put in place, right? Staff duties should be rotated from time to time so that members do not perform the same function for a considerable length of time. Every member of the staff should be encouraged to go on leave at least once a year. Why is this? Because when the person will be on leave, so the other person will come in, look at the work which this person was doing, so that if there are any wrongdoings, the other person will get to know about it. Yeah. Persons having physical custody of the assets must not be permitted to have access to the books of accounts. Why? Because at two places the reconciliation will be going on, and that can be again performed. So we can say that can be giving the desired objectives when two different persons are doing this exercise. If the same person is having the physical custody, he may put down anything in the books of accounts, okay, which is inappropriate. There should exist an accounting control in respect of each class of assets. In addition, there should be periodical inspection so as to establish their physical condition. Mechanical devices should be used wherever practicable to prevent loss or misappropriation of cash. Budgetary control should be exercised and wide deviations observed should be reconciled. For inventory taking, what is inventory taking? Physical verification. So that is what you call as stock take or inventory taking at the close of the year. Trading activities should, if possible, be suspended, and it should be done by the staff belonging to several sections of the organization. Okay, so different persons are coming in. Financial and administrative powers should be distributed very judiciously among different officers, and the manner in which those are actually exercised should be reviewed periodically. Okay, procedure should be laid down for periodical verification and testing of different sections of accounting records to ensure they are accurate, right? Next, so let's look at this one. Compute the overall audit risk. If looking to the nature of the business, there are chances that 40% bills of the services provided would be defalcated. Inquiring on the same matter, management has assured that internal control can prevent such defalcation to 75%. At his part, the auditor assesses that the procedure he could apply in the remaining time to complete the audit gives him satisfaction level of detection of frauds and the error to the extent of 60%. Okay, so in this case, what is it? You can say some sort of arithmetical calculation will be required. So analyze the risk of material misstatement, which comprises of what? Inherent risk and control risk, and find out the overall risk. So when you say overall audit risk, so that means you are talking about risk of material misstatement and detection risk. Yes or no? Yeah. So that's what you're, yes. Okay. All right. No worries. So I'm waiting. So whenever you'll say, I'll continue. Is it okay now? Sure. Because anyways, I'm thinking we are just about to wrap up the discussion. Huh? So, huh. No, so should I conclude it now or should I continue? All right. So I'll conclude at 10, huh? Right? Okay. So I'll continue. All right. So now moving back. All right. So now in this case, let's look at this. As per SA 200, okay, which talks about the objectives of the independent auditor, conduct of audit. Audit risk is what? It's a risk that auditor will issue an inappropriate audit opinion. So this has got two components as we just discussed. Risk of material misstatement, detection risk. Correct? Now, in case of risk of material misstatement, which is about inherent risk, control risk, we can also again have a discussion as around what is this inherent risk. Inherent risk is the susceptibility of the assertion in relation to the account balance, class of transaction, disclosure towards misstatements, which may be either individually or collectively with other misstatement, okay, which may become material before considering any related internal control. Okay, so in the given situation, that is given as 40%. What is control risk? It's a risk that there may be chances of material misstatement even if there is a control applied by the management. It has prevented defalcation to 75%. Okay, now what is the risk of material misstatement? So it's sort of combination of these two. So risk of material misstatement is anticipated risk that a material misstatement may exist in the financial statements before the start of audit, in something which the management has not been able to control. Yeah, we just got these two components we just talked about, right? Okay, now in this case, control risk is what? 25%. Why? Because if the prevention can be done to the extent of 75, so 25 can't be done. So that's the control risk. So what is the risk of material misstatement? That is inherent risk and control risk. So that is 10% for us. That's one. So chances of material misstatement are reduced to 10% only by the internal controls applied by the management. So that is the first part. Okay. Now, detection risk. What is the detection risk? We talked about it. It's a risk that a material misstatement remains undetected even if the audit is done. Okay. And the detection risk is given as 40%. So what is the overall audit risk? Overall audit risk is what? Risk of this material misstatement and this detection risk. So what is that? 10 and this 40. So if you do this, where do you reach? 4%. Clear on this? Yeah. All right. Clear, everyone? All right. So with this, I think we are through. I'm just hoping you have been able to understand these requirements. Quite important in the context of audit and in the context of audit planning, I would say. And that's why I believe this is a very important part of audit planning. Yeah. So with this, we can just conclude our discussion. Thanks everyone for your time and for this participation. Thanks so much. Yes, Manish. Okay.